Today, we're talking about required minimum distributions, also known as RMDs. They are a pivotal role of retirement. Most people will have them throughout their life. I can't tell you how many people I've begun working with that are in their 70s, 80s, 90s that have now experienced RMDs. And they're hoping, man, I wish I would have planned 10, 20, 30 years ahead because then there's a lot more options you can do. So today we're going to talk through what RMDs are, try to learn a little bit of the reasoning behind the rules and what we may be able to do about them. A little preface here. All the rules we're talking about are for your own retirement accounts. There's very different rules for if you inherit an account. First off, what is an RMD? An RMD essentially is where you made a deal with the government that I will take tax deductions the year I put the money in when I'm saving for retirement. But on the flip side, when I use that when I'm retired, then they can tax you. The most common examples are traditional IRAs, where a lot of people maybe work somewhere, had a 401k and an IRA that they were contributing to. They retire, they consolidate them to their IRA, but it could affect 401ks, IRAs, 403bs, 457 plans, deferred comp plans for often higher earners. Let's look at an analogy. This analogy, it's a little bit of a stretch, but I try to meetings make things a little more understandable and not just throw out financial words at people. I give a lot of crap to my wife. She's in uh, med school right now. And so she always tells me, hey, you got to go get your annual physical. And I'm like, I don't need it, but she makes me go. And I know she's going to ask me questions about what the doctor says. So I try to jot down some notes. And essentially, what happens is they come at me and they say words like hemodynamic and idiopathic. And I'm sitting there like, what the heck are we talking about? And then I leave that meeting with my doctor having no idea what we just talked about. And then I ask my wife, and she goes, oh, that just means your vital signs are fine. I'm like, well, why the heck didn't they just tell me that? I don't speak that language. Just put it in easy enough, understandable words. So that's kind of when I like to use analogies and metaphors. So I'm using the restaurant analogy here. Let's say you have a favorite restaurant and you go there all the time. You order your favorite foods and you make a deal with the restaurant. Hey, don't bill me every time I come. I'll pay you back years from now. Now, is the restaurant probably gonna do that? No. But you continue to go, you continue to eat. And then when you're done eating there years and years later, then they say, hey, let's settle the bill. Here is what you owe. And that's where you'll start paying the taxes. So yes, it's a stretch, but hey, when you're saving in these retirement accounts and you're taking tax deductions, you're essentially deferring your taxes to where you're going to use them later, and then you'll settle the bill. And an RMD is a way of the government saying, "Hey, you haven't given us money yet. You have to start giving us money." When must you start taking RMDs? These rules just did change at 2023. The most common one is if you're born after 1960, which most people now are getting there, it's age 75. So this has been pushed back a handful of years, which is very beneficial for you. It used to be 70 and a half. And then, it's still 72, 73 for some people, but most people now it's around that age 75. You have to take your RMD before the end of the calendar year, December 31st. You don't want to miss it. And we'll talk more about that here. There is one special rule for the first year where you can say, hey, I will take my RMD the next year before April 1. It's April 1, not the tax filing deadline, which a lot of other items are. That's April 15. April 1. So you can say, let's say I retired in 2027. You can take it out, February of 2028. But then you have to take two that year, and then you have 2 years of RMDs that will count as ordinary income. So it's an option, but you might want to look at your options there. Penalties for missed RMDs. You do not want to miss your RMDs. The IRS will hammer you with taxes. They actually cut it down. It used to be 50%. Now it's 25%. So that's nice, but it's still a 25% penalty on top of the taxes you'll owe. So make sure you have a calendar or your advising team tells you when the RMDs are, or if you do it online, put a task or however it works, just don't want to miss them. Because if your RMD is say 80,000 for the year and you miss it, you're looking at a $20,000 penalty and the taxes you'll owe. So it's quite brutal. It is possible if you miss your RMD and you promptly fix it, You could argue, I want to get that reduced closer to 10% penalty. We've seen it happen, but the rule is now 25%. Calculating your RMD, look, your broker dealer or firm's most likely going to run that number for you. So they will tell you how much you need to take and then decide what you want to do with it there. Some people like to actually know how it's based. What you do is you find the balance at the end of the year, so December 31st. Then you look up what your life expectancy factor is, which there's a table that the government puts out. Hey, if you're this age, it's this number. And then you take your balance divided by your life expectancy factor. Long story short, if you're in your mid 70s, 73, 74, 75, 76, it's going to be give or take around 4%. And then it will go up a little bit each year. Say you get 2 million bucks in IRA money, you're looking at give or take $80,000 of an RMD. Let's look at the potential impacts of RMDs. First, let's preface this. If you have large RMDs, you've most likely saved very well and accumulated more money than you need to live off of. So you should be proud of yourself. A lot of people are like, well, this is terrible. Well, you have a lot of money. You've done a great job. You don't need it. I personally, yeah, I'm with you. I don't want to pay any more than I legally have to pay to taxes. So let's look at strategies to reduce those lifetime taxes, hopefully. But first of all, maybe pat yourself on the back and say, hey, it's not easy to save a lot of money for retirement and spend less than you make all those years. But what are the potential impacts of RMDs? We talked about it. If you're 75, you got 2 million bucks, you're looking at about 80 grand. So then you have Social Security. If you have, anything that produces income or capital gains, that could be CDs, money market accounts, you're getting a pension or annuity payments. Those are income. So we got to add all these things up. So what begins to happen is you begin going into higher tax brackets possibly. So I have a person there, 87-ish years old, and they are spending the same amount pretty much for the last 10 years, but their tax bracket continues to go up and they're confused why. Well, it's because their RMDs continue to get larger and larger. And so then what happens is it increases their tax bracket. They go from the 12% to the 22 to the 24. Then you start looking at increased Medicare cost. So if you have too high of income and RMDs are a factor there, your Medicare premiums could go up and it goes up pretty high pretty quickly. Then there's net investment income tax. This is an additional 3.8% surcharge on income above certain levels. So if you're getting pushed up into higher brackets, now we're looking at increased Medicare cost, which could be extra couple $100 a month. 3.8% on more money. And this one really actually hammers married filing jointly because it's 250, singles is 200. So yeah, it's higher earners, but there are people spending 3, 4, 5, 600 grand in retirement. So when we have to worry about net investment income tax, then the widow penalty, that one is essentially, hey, when you're both alive, you're married filing joint, so your brackets are larger, so your taxes are lower. Well, if somebody passes away, then you quickly begin filing single, or the tax brackets are a lot less. So it's the widow or widow's penalty. Some people say, hey, we're in a good bracket now. Let's look at conversions or pay some taxes or spend it while we're both alive. And then once RMD started, it kind of limits your tax plan options a little bit. There's still things you can do, but you have to start taking this and paying income on it. So there's less, I would say, tools in the toolbox at that point. Feel like I just spouted out a bunch of terrible things that RMDs can produce. You've done a great job saving. You have to take money out. I'm not trying to scare you or any reason. It seems like you have enough money if this is the case. However, half the fun of my job is to try to plan and work together and strategize with clients on, hey, how can we try to have you spend more or pay less in tax or get this to the kids in a more tax efficient manner? So those are just a couple ideas. One huge thing we look at is QCDs, which is a qualified charitable distribution, which is just a fancy word of trying to say we want to give really tax efficiently to charities. And there's a nice way you can do that, even when you take a standard deduction. So most people, when they're giving, unless you're itemizing, you don't get a tax write-off for that. A lot of people don't even notice that, but when you look at your tax return, you do. If you itemize, then you can take deductions. However, this can be very valuable. So if you can give money right from your IRA to a nonprofit, it has to be an official 501c3, You can give it to them. It reduces your RMD, and you don't have to pay income tax on it. So I have a couple clients where right now we started working together, and what was happening was they have an IRA. They take the RMD, then they give it to a charity. Well, what just happened? We received the cash, we paid tax on it, then we gave it away. So the only way we're going to write it off there is if we're itemizing. Well, we're taking the standard deduction. So what if we do? Hey, let's send it directly to from your IRA. We'll mail a check directly to this nonprofit. You don't receive it, but it counts to lower your RMD. You don't pay tax. The nonprofit doesn't pay tax, and you can still take a full standard deduction. So even if you're itemized, you might want to look at this. I have somebody who they're in their 80s, and what was happening was they were giving money as a QCD to a nonprofit, and then they were itemizing. Well, they were giving $15,000, $20,000, $25,000 away, and they were just barely itemizing by a couple $1,000s. Well, what we looked at doing was, well, let's give the charity the QCD, then let's also take the standard deduction. So instead of taking an itemized for 4, 5, 6 above the standard, we take the standard and the QCD. It gets a little confusing, but those are a couple ideas you want to really consider with these. It works very nicely when you're taking standard deduction as well, because you get that deduction. Now you have to be 70 and a half here. This used to go at the same time as RMDs, because RMDs used to be 70 and a half. RMDs have been pushed back, which is nice, but this, they did not change. It was a little thing that not many people talk about. This is still 70 and a half. So if you're 71, 72, 73, you don't have RMDs and you're charitably inclined, you can give it still and still get that write-off with the QCD. You can do up to $100,000 a year. That's a very large number. You might want to look at bunching there, but counts towards your RMD and you get the full standard deduction. So what to do with your RMD? What I tell clients are, hey man, hey guys, let's spend it. You've worked your entire life. You've worked very hard. You've put away more than you have to have right now. Do you have anything you want to do? Anything you want to buy? Any trips you want to take? Maybe a lot of times it's, hey, I want to rent a house at a lake and have all my family there and I'll pay for it. I tell people, spend it. It's your money. Now, some of them say, hey, we're doing everything we want to do. We want to reinvest it. You can reinvest it. So you take it to pay taxes, then you reinvest it oftentimes in maybe a trust account or a joint account or whatever structure is right for you. Then in that account, you get a little more efficient strategies where, okay, that's where you get taxes each year. So maybe we hold certain assets in our IRAs, certain assets in our trust account for more tax efficiency. Or you can gift or transfer it. Sometimes it's to help fund grandkids' college or housing or whatever. That's another thing people do. You just want to have a strategy in place before and talk about it ongoing. So planning ahead. So before RMDs years, this is where it can be very valuable because, like I said, I have a lot of clients in their 80s and 90s where now we're getting hit with large RMDs and we're seeing increased brackets and increased surcharges. Well, what can you do before it? Especially if you're in a lower bracket or you're happy with your bracket. Maybe that's 12, maybe that's 24 instead of 32. We look at Roth conversions. I say, hey, let's eat some vegetables now. So later we don't have to eat only vegetables. So let's eat vegetables once a day, pay some taxes. So later we don't have to eat breakfast, lunch, and dinner vegetables because we've already front paid some of those taxes. That's what we're trying to do with Roth conversions. It's not right for everybody. So you want to look at your numbers there. And then during your RMD years, don't miss them. Set a reminder. Don't miss those RMDs and get the penalty, QCDs. Review your tax planning because there's new tax laws that come out. One thing we look at, hey, if the market's down a lot, maybe we want to look at Roth conversions if that's something right for your plan. Because if the market goes down 20% and you convert certain funds, and then the market goes up, well, I convert it at a lower price, and then I get the growth in the tax-free Roth account. That was a lot of information. I try to make it understandable, but there's certain terminologies you just have to know so it doesn't get confusing. I hope you found it helpful. We could break this down into 5-6 minute videos on so many different topics. And probably in the future we'll do that. But those are some of the main things. When we look at RMDs, you want to have a plan and you got to know how much needs to come out so you can avoid those penalties. Hope you have a great day.
Let's make sure we're on the same page. This is general educational info, not personal advice. We don't know your goals or financial situation. Before making any decisions, it's always recommended to talk to a qualified professional who can tailor guidance to your specific needs after learning more about you. Here are some more exciting disclosures to help make this even more clear. This information is not intended to be a substitute for specific individualized tax or investment advice. Securities offered through LPL Financial, member FINRA/SIPC. Investment advice offered through Harborfront Financial Group, a registered investment advisor. Harborfront Financial Group and Custer Financial Advisors are separate entities from LPL Financial. Investment advice will only be given after a client engages our services by executing the appropriate investment services agreement. Harborfront Financial Group DBA Custer Financial Advisors CFA is a registered investment advisor RIA. Registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. Custer Financial Advisors renders individualized investment advice to persons in a particular state only after complying with the state's regulatory requirements or pursuant to an applicable state exemption or exclusion. All investments carry risk. No investment strategy can guarantee a profit or protect from loss of capital. Past performance is not indicative of future results. Advisory services offered through Harborfront Financial Group, CRD number 331763,